the bank loan, there's the bridge loan, and then there's agency. They each serve a different purpose. So think of the bank loan is for maybe a newer sponsor or someone who's trying to reposition an asset. It's maybe a light value add deal or potentially a heavy value add deal. The bridge loan is a value add or a heavy value add. The bridge term comes from bridging a property from unstabilized to stabilized. So it's literally a bridge from a poor property to a good property. And then agency, which is Fannie Mae and Freddie Mac, are two government agencies, and that's much more for a stabilized product. So something that's occupied, it's already at kind of at market, and it's just chugging along. So the bank loan, this is your local bank. This is credit unions as well. You drive down the street, you see them all over the place. There, you've got probably got billboards in your city with the face of the banker.
Yeah. Which
Uh, um, so this bank is generally, if you're going to start out, this is where most investors will start with. Let's say maybe you're doing a 10 unit. This is at the bank that they get their funds from their deposits. So you go and put deposits at their bank, and they use that and they lend it out. Generally, the right now the terms are roughly 70 to 75% loan to value. It's a 5-year term, a 25-year amortization. The big benefit for banks like this is, let's say the property's 70% occupied and you're going to go in and you're going to fix it up and get it to 90. A bank will be okay with a maybe a not fully occupied property, and they'll be willing to take a risk on you a little bit more than the bridge or the agency will. So this is why it's a good option for someone who's starting out. And then bridge loan is really a property that needs a lot of work, that needs hundreds of $1,000s worth of rehab, and so the bridge loan is willing to include the rehab into the loan. So we did a deal recently. It was a 20 unit in Georgia, and they were able to finance a 75% of the purchase price and then 90% of the rehab. So they had to 80% total loan to cost. They had to come out of pocket very little in terms of the full the rehab dollars and things like that. And so they take those loan dollars, they use it to fix up the property, and then they refinance. So this is it's a riskier loan. It's generally 75 to 80% loan to cost. The interest rates will range depending on the loan size, and it's generally a 2 to 3 year term, interest only. So that's the bridge, and then the last is agency, which is Fannie and Freddie, and again, this is for a stabilized property. This is for more experienced sponsors. This is a very low risk type property. And they're generally, they can go up to 80% loan to value. You can do a 10-year term, 15-year term. And one of the huge benefits to this is it's a 30-year amortization. So you can really push out that cash flow, and it's non-recourse as well. So you're not personally liable for the debt.